The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, my darlings, this is Esther Gulius, the tax lady from EG Tax, and we're here to help you with your taxes. 'Tis the tax season, and let's face it, we only have, a little over 3 weeks to go, right?
That's right.
And that's Tiffany Fabian. Christopher Fabian's working. We wouldn't let him come out today. He had to do tax returns. So we're here to help you. 803-0930, 803-0930, star 930 on a cell phone. We have all 30 of our offices open tonight till 5. The McKinley Mall office is open tomorrow on Sunday. That's the only one that's open. The rest of our offices will be open Monday through Friday next week, 9 to 9. And I will tell you, we're in the home stretch. Have you gotten your state refund? Are you getting letters from New York State? Do you know what to do? Are you getting letters from the federal? Are they holding up your refund? Give us a call, 803-0930. 803-0930, star 930 cell phone. We kind of have a theme today. We're going to talk about getting down to business because a lot of people aren't even aware what they should do with their business income. If you're getting if you're paid on a 1099 and you have non-employee compensation, that means you're self-employed, and so you have to. And it might not be legal, by the way. You should maybe not be self-employed. You should talk to the person that hired you about it. But if you're truly somebody that's self-employed, we want to talk about things you should think about in business. If your kids are self-employed, things to help them in business, because there are a lot of things that you can write off when you're self-employed. As a matter of fact, with the change in the tax law this year, if you're an employee with employee business expenses, you really can't deduct them on the federal. They're only deductible on New York State, and then New York State is sending out letters, right?
Yep. New York State is sending out letters again asking for proof of withholdings. And so your withholdings on your W-2s, your 1099s, your it wouldn't be your Social Security, anything that has New York State withholdings on it, they want to see proof. And then once you get the proof in, it takes them about 3 months to process it. So make sure you get the clock
But here's
ticking.
the thing: it's like playing tennis. Puck, they hit the ball over to your court, and that's the letter. And they're saying you need to prove your withholding. If you just say, "Too bad for them, let them figure it out," they'll never send you your money. Mm-hmm. Yep. I mean, you have to respond. If you don't respond, then they're not going to send you your money, and that's so important. So if you need any help with that, and you're getting love letters from the federal or the state, give EG Tax a call, because we're here to help you.
Yeah, and I called New York State last year, and I asked why they're doing it, and they said that the reason that they're doing it is to protect your identity. So I beg to differ.
Okay. All right. Anyway, let's say that you have a small business. Now, first of all, just because you don't have a DBA or you're not licensed, does that mean that you're not self-employed?
No.
If you're getting income that isn't from an employer.
You would still be quite possibly self-employed.
Right. I mean, if you're getting money, you're walking a dog, you're painting houses on the side, you're cutting grass, you're doing babysitting, and even though you don't have a license, you're still self-employed, and that income goes on a Schedule C.
Correct.
Right?
Correct. It does. So, and a lot of people are very confused by that, but even though you don't have a license or a DBA, you still potentially are a business.
Well, if you're getting self-employment, you're a business.
Right.
You're treated as a business for
Profit. Right.
tax purposes, right?
Yeah.
So now, then there are people that have hung out their shingle. They're not just kind of doing solo stuff, kind of cutting grass, but there are people that have a storefront, right? They're a little more complicated. And the first thing, if you have that situation where you are doing your own business, think about becoming a limited liability company. Why?
Because then you have protection. So should somebody slip and fall, should somebody not be happy, pleased with your services because you failed to perform, they could sue and they could go after your own personal assets.
Whereas if it's a limited liability company, they can only go after the assets
companies.
of the company.
Right.
So that's something that you really, really should think about. And the other thing is keep good books.
Right.
I know not everybody likes keeping books, but
Right.
QuickBooks is a great system. There's all kinds of great ways of keep. You can just keep it simple. Income in, expenses out, save all your receipts.
Yep.
Because in the event of an audit, believe me, you're going to need it.
And that goes for landlords and rental owners too. I was doing a tax return yesterday for somebody who just wanted to lump all of his rent under his one apartment where he had 4 others. And so he did the same thing with his expenses too. And unfortunately, that doesn't work.
Right.
So
right.
we had to do a lot of.
You had to peel it all back
Right.
and allocate.
Right.
And that's from our perspective when we see somebody that comes in and they're disorganized, you really shoot yourself in the foot. Because we can't do for you what should be done because you haven't spent the time to get everything together. I'll give you an example. We usually do like a mid-course correction maybe every quarter. We with our businesses that we take care of, we have them bring in their QuickBooks or their books, and we look and make sure that they're doing things the right way.
Yep. Because then it's not the end of the year and you're stuck holding the bag.
Right.
You can fix it easier.
I'm Esther Golias, the tax lady from EG Tax, 8030930. 8030930, star 930 on your cell phone. You can text us at 3930. All right, mileage. How is that deductible on your self-employment?
It's deductible per mile, or you can do actual, whatever way you deem is the best way. So you could do, what are we at, 54
cents
a mile. And so you could take all of your miles. So if you have an office in home, you could take your miles from home to your clients' houses to
As
go
long
to
as you're
Office
working.
Max. Right. As long as you're working, you have an intent to make money, you could take all your miles.
So if you travel 10,000 miles, you get a deduction of $5,450.
Yes, ma'am.
That's a lot of money.
That's a lot of money.
And if you're not keeping track of your mileage and you're not taking it if you're self-employed, you're overpaying your taxes.
Yep,
right?
Yep. I did last night I did people who deliver newspapers for Buffalo News, and so their mileage is really a big glop
Part of their
what their
deduction.
expenses. Yeah, huge.
So, and the thing is, if you're listening to us and you have never taken this before, you can amend the last 3 years returns and get money back on a deduction that you've missed.
Yep.
Right?
Absolutely.
I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. We're going to take a short break. We'll be back on the other side with your calls. And that's tax music, if I ever heard it. I'm Esther Golias, the tax lady. We got 30 area offices to serve you. We're in the thick of it. You should have gotten all of your statements by now, and you should be, if you haven't done your return, you should be in the middle of doing your return. And if you have any questions, you can give us a call at 8030930, 8030930, star 930 on a cell phone. 3930 is our text number. And we're kind of talking about being self-employed. One of the most common self-employment is being a real estate person.
Yep. Really,
and talk
really
about
common.
mileage. They would have a lot of mileage.
Yeah.
Plus all those BNR fees and all that stuff.
Yep, the fees, the cell phone, potentially have an office and home, and the mileage and the continuing education. A lot of them get gifts for their clients when they first when they buy a house, and so there's lots and lots of expenses. So bookkeeping, like you said, is so important, and you don't want to just be going into what your business is at the end of the year haphazardly. You want to keep track of it,
Right. But and the other thing that I think real estate people miss is the simplified employee pension deduction.
Yep.
Because, for instance, if your net profit at the end of the year is $40,000, you can put aside about $10,000 in an SEP. And so that would save you state and federal about, $10,000 save you about $3,000 in taxes. So that's really, really important. And when you're by yourself, you can do a solo 401k plan and put tens of thousands away in a pension plan.
Right, which is something that a W-2 employee doesn't have the luxury of doing. So it's a really good advantage. So in SEP, it's 20% of the profit?
20%. It's actually 25% less the adjustment for the FICA, so it ends up being 20%.
And you got to make sure that the SEP is set up before tax season, or else you can't do it.
No, SEP doesn't have to be.
Chris told me.
Simple has to be set up.
Okay, Chris told me SEP did. He just told me this week. Okay.
Simple has to be set up.
So he's like,
right. And the other thing is you can also make a contribution to your SEP up till the extension deadline. So that'd be October the 15th.
Yep. So you could potentially do an extension, and it's an extension to put money in the SEP, which is really cool.
That's right. So that's another thing. The other thing when you're self-employed is if you have business loans, like maybe you got a MasterCard that's dedicated, make sure you use that interest on that Schedule C and the like you're talking about, the office and home. And then the other big thing is the pass-through deduction.
Yeah.
So many people aren't even aware what that means. It's over and above your itemized deduction. So if we had this person with a $40,000 net profit, they would get an $8,000 over and above everything else, pass-through deduction.
And don't forget that qualified business credit that you're talking about. If you have a K-1 and you're a partnership or you're part of an S-Corp, you can also take advantage of that qualified business credit that Esther was talking about as well. And then also don't forget, if you have dividends this year, there's an indication on the dividends that
if you're in a mutual fund, many of the mutual funds are saying 199. There's a 199 allocation.
Mm-hmm.
And if you don't know what 199 is, you're going to miss it, but that's that pass-through again.
Yep. I've been taking advantage of a lot of that for my clients.
All right. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. We're going to go to Mr. Ray. Hi, Ray.
Hi. Is this Esther?
It is.
Hi. I talked to you about a year ago. I want to thank you, by the way. I went down to see your I think it was your son-in-law down on Niagara Falls Boulevard last year, and he helped me square away a mistake I made on my 2017 and 2016 tax.
Well, that's good. I mean, that's really what we're there for. We really want to help you.
And he charged me practically nothing, although I shouldn't tell you that.
No, but that's another thing that we try to do. We try to keep our prices very reasonable and very affordable. Well, what can I help you with, Ray?
I just retired July 1, this past July 1, as a pastor, a clergy person. And it's my understanding that my pension money that I just started receiving July 1, as long as it doesn't exceed, the fair market value of the house I'm buying.
It can be considered a parsonage.
It's not a parsonage because I just retired July.
Right, but I mean the housing allowance. Excuse me, I used the wrong word.
The housing allowance.
Right.
I don't get anymore because I'm retired. I'm just getting a pension.
Right.
And I understand that it's tax exempt up to the value of the cost of my house, even though I'm retired.
That's correct. It's considered a housing allowance if you're a retired minister, which is a phenomenal blessing for you.
Yeah, I was a blessing to them. Now they're a blessing.
That's great. Now, you have to understand that housing allowances are subject to self-employment taxes unless you've opted out of FICA.
Well, yeah. Well, I'm 68, so.
Right, but you still have to pay self-employment taxes for forever and ever as long as you have self-employment income. So it is considered a housing allowance, so that's really a great thing for you.
Now, that's not considered self-employment income then, right?
You have to pay the FICA on housing. Yes. And are you and I'm assuming you're spending it all on housing as well.
Pretty much, yeah, because I only had 18 3/4 years that counted toward my pension. I was a pastor longer than that, but they only counted 18 3/4 years because that's what I was full-time.
Right. Well, that's great. Well, congratulations, Ray, and thank you for your service in the Lord's work.
Yeah, and you and I have a mutual friend. She's the one that gave me your number last year.
And who's that?
Kathy A. from Hunt Real Estate.
Oh, my gosh. Oh, she's wonderful, isn't she?
She is. She helped us buy the house we just bought in Depew in October. So
that's great. Kathy Anderson is a wonderful, wonderful lady.
She really is. I've known her for about 25, 26 years.
And if you want a great realtor, Kathy Anderson at Hunt is phenomenal.
She was instrumental in Chris and I getting our new house a couple of years ago.
Yep, and I know that she's kind of dialing it back a little bit because she's looking at maybe going and not really retiring, but kind of not working as hard. So, but Kathy Anderson is remarkable.
Yeah, she sold our house in Snyder, too, in 1 month.
Well, that's great. So, Ray, thank you so much.
Yeah, thank you, and
All right.
take care.
God bless. Bye-bye. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. The other thing with businesses is, and this goes across the board, don't think because you bought something that's deductible and you've overpaid for it that that's a good thing because it's a write-off. But you would never go and spend money
Right.
that you don't need to spend.
Right. I was just doing a landlord's Schedule E, and I asked if he paid for snow plowing, and he said, no, should I? And I said, no. It would never make any sense.
Because for instance, if you're in the 10% bracket, if you pay $1,000 for something, you only save $100 in taxes.
Yep.
So you want to be very careful that you don't just say, oh, well, it's going to be a deduction, and so that's why I'm going to overpay. You don't want to create a deduction just for a deduction's sake. You want to make sure that it's ordinary, necessary, and it makes sense for you to spend the money, because don't spend the money. I just did a tax return yesterday for somebody that outfitted a rental unit that she had in Florida, and she paid $70,000 for 2 bedrooms of furniture and a living room and a dining room. And, she went to like Pier 1 and did it top of the line. And, you just can't. Maybe that was good, but I think that she could have saved a little money.
Ordinary and
necessary. Right.
Yeah, that's a lot of money.
So I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on your cell phone. The other thing is you can take personal items and place them into service.
Yeah, yep, that's right.
In other words, if you're starting a small business and you're thinking, boy, I got not too deep of pockets and I want to be very frugal, you can take your computer that you had in your home office and maybe you were using it personally and place it into service in your business. And the fair market value at the date that you placed it into service, as long as it's less than what you paid for it, can be used as a write-off in that business.
I think there's so many people that don't take advantage of it. They're like, nah, I already had that. But it wasn't used for business purposes. And I can't tell you how many.
But if you start using it, the fair market value of that thing that you're using in business is now a deduction.
That's right. Yep. Which missed over and over and over repeatedly.
All right, let's go to Larry, my friend in Georgia. Hey, Larry.
Hey, Esther, dear, I'm a little bit nervous if it's my fault. I just want to make sure that you got my 1099s and my check. I still have to email you my little cheat sheet, but I'm leaving Wednesday and won't be back in the country till about May 14th.
Chris has got it.
Yeah, we have it, and I think that he's working on it tomorrow. So. Because he's aware of the fact that you're going to go, Larry, but we will beat him over the head when we get back to the office and make sure that he knows Larry's got to get his taxes done tomorrow.
Well, all I can say, darling, is beat him softly because he's a good man.
No, believe me, I'm not really going to beat him. But the thing is, Larry, if there's a missing piece, will you get that to him right away?
Yeah, I will.
I mean, when you hang up with me, sit down at your computer and email Chris so that he has everything.
Yeah.
When he sits down, he can get it done.
And Larry, it's so funny. So many people this year are like, oh my God. I mean, it's really nerve-wracking because of the tax reform. So many of my clients are like, I just don't have any mind's eye of what the answer will be this year, So it's even, it'll be more interesting than usual. Yes?
Well, dear, all I can say is it's who I call wonderful folks at EG Tech with ESP always.
Thank you, Larry. I thank you.
Okay. Thank you very much, Larry. Hey, and have a good time if I don't talk to you. I think he's gone. Wherever he is, he's going on vacation. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Somebody doesn't like that you say yep.
Well, it says, it could be you. It says that it was the lady who's on every week. I don't know.
Okay. Well, I don't. think I say yep. But anyway.
I don't know. Maybe it's me.
All right, let's talk about rental property too. And there's
be me.
lots of rental properties in Western New York.
There are
You know,
lots.
and whether you live in a duplex or a up and down, side by side, whether you have a tenant above you, maybe the whole thing is rental property. Under the tax reform, you also would qualify for the QBI deduction of 20% if you're handling it as a business. So that's really important too. And I will tell you, if you have rental property, I would sincerely think about making those limited liability companies as well, because if anybody trips, if anybody has lead paint that they're eating, God forbid, in some of these older homes, it helps to protect your personal assets, and the only thing at risk would be the rental. And I will tell you, if you need any help, go talk to your attorney about this, because an LLC on your rentals is another really important thing. Hey, we're going to take a short break. We're going to be back with on the other side. 8030930, 8030930, star 930 on a cell phone. 3930 is our text, and we'll be back after the news. Hey, that's music to hit the computer keys by. I'm Esther Golias, the tax lady. 8030930, 8030930, star 930 on a cell phone. Yes, there is a way to listen to my past radio programs of Esther. I think it's on our website.
It's on our website. Tim Eliason loads it on the site. And so if you have problems, just let us know, and we'll get them to you. We'll email them to you.
Yep. All right, so now we were talking about businesses. The other thing is, and I know we have calls coming in, 8030930, 8030930, star 930 on your cell phone. Make sure that if you're loaning money to your business, that you don't count it as income.
That's right.
Many times I'm doing a tax return, and I'll be going through the income statement, and I'll say, well, what's this income item? And they'll say, oh, well, that's my loan I made. Loans to your business are not business income. So if you've been loaning yourself money and you've been putting it on your corporation or your partnership or your Schedule C, amend the returns and take them off. Loans are not taxable.
That's absolutely
correct. And even
correct.
whether you loaned it to you from yourself or you loaned it, you took the money from a bank, it's the same. It's not income. What other thing did I want to say? Placing service. Okay, I think that's about that on businesses. But businesses are very important. And the other thing is rentals. Treat them like a business so you can qualify for the QBI, which would mean you have a separate bank account. There's a safe harbor deduction where if you spend at least 250 hours a year, you can take the QBI deduction. Operate it like a business. And all expenses are deductible. I know a lot of my clients that I've talked to that have rental property think that because property taxes are capped as an itemized deduction, that it's not deductible, but that's not true. Property taxes on businesses and property taxes on your rental property is deductible.
Yeah, and I wanted to say about the safe harbor. So that also means that there's items that you usually depreciate, which you have to take a little bit. If the useful life is less than 20 years, you can use the safe harbor provision, and you can depreciate all of it right up front instead of doing.
You can expense it.
Yeah,
right.
Exactly.
All right, let's go to the phone. We're going to talk to Kelly. Hey, Kelly, how can we help you?
Yeah, hi. Thanks for taking my call. My father gave me a piece of property. He deeded it over to me last year, and I sold it for $365,000.
Huh.
Now, he purchased the property. Well, it's a long story, but he passed shortly after he had given it to me. But
wow.
Anyways, but when he bought the property, it was a private. The seller held the mortgage, but it was actually the mortgage was for two properties, but it never differentiated how much was for each. And I don't know what cost basis to use. He paid $450,000, The other parcel is basically worthless. It's industrial property that has all kinds of environmental concerns. I don't know how to report it on my taxes as what the property costs.
All right. So you sold it for $365,000, but it cost him $450,000.
Yes, but that was for 2 pieces of property.
All right. So how long ago did Dad buy the property?
2000.
I would talk to a qualified real estate appraiser who could then help you to determine the correct allocation between those two parcels of land. Has the condition remained relatively the same since your dad purchased them?
Yeah, well, the one parcel's worse, and the other parcel's the same. The other part of the property I got was vacant land, and the other one is a scrappy.
Well, the first thing you need to do is before you even sit down to do your return, you got to make sure that you can find a proper allocation between those two properties, and using a real good real estate appraiser that can help you would be the first step that I could see, because the burden is going to be, in the event of an audit, the burden of proof is going to be on you to determine how this was allocated, and you have to have somebody that's qualified. I wouldn't just call a realtor. You got to make sure you get a good real estate appraiser, somebody that's going to go through the records and see, and it may be costly, but in order to come up with the correct basis, that's what you're going to have to do.
And then also, it's really important to say, Kelly, that when something's deeded to you, that means it's gifted to you. And so that means that it goes back to the original basis, which means that you have some work to do.
Well, that's why she said her dad was $450,000. You're not entitled to a loss when you sold a piece of property that was given to you from a relative. So that's another piece of the puzzle that has to be all fleshed out as well. So start off with your appraiser, and then if you want to call us at the office at 632-7886 or email me at egtax@hotmail.com. I'll be very happy to help you kind of point you in the right direction so that you get the correct basis.
Okay.
All right, Kelly?
Thank you.
Hey,
Thanks a lot.
Thank you, dear. It is really a conundrum, because that's what's so important. You know, we are all finite human beings, and the only way we're going to get out of this world is to die. Mm-hmm. And so it's important that you have those conversations with your children now, while you're alive, while you're in good health, while you can still think, while you know what you paid for things. Write down those numbers, because after you're gone, you end up in Kelly's situation. You don't know what to use. And unfortunately, if you can't determine the basis goes to zero. So you want to make sure that that you have those conversations with your kids. It's a really good thing to do, is to tell your kids where the money, and a lot of times, lost money, people will say, I found lost money through New York State. Well, that's because the facility that that had the asset didn't know what happened to you. And so if you do kind of a after I'm gone letter, this is where my assets are, this is what I have, all those things are important, and especially if you're gifting things to your children. Now, had Kelly inherited it, we've been having a completely different conversation.
Right, because she'd get the stepped up basis at that time. And so there's a text call. It says, my son is 15 and referees sports and paid per game. He will make more than $600 this year. Tax rules, ? Also, our nonprofit club pays a flat fee and issued a W-2 and insured with disability withholdings, etc. Several thousands to each individual over 18 to run some programs. Are these independent contractors with a W-9, or are they really an employee subject to withholdings? Help.
Okay, so let's start off with the son. So the son is a referee and he's self-employed. So he's going to do a little Schedule C, and he's going to be able to reduce part of the money that he's getting for refereeing by some of his expenses. And some of his expenses would be driving, if he's driving his own car. But if he's driving mom and dad's car, then all he'd be able to do is take the expense for the gas if he filled it up.
Right.
to take for those games. But maybe
Cell
he's got to
phone.
buy a little striped uniform, and maybe he's got a license, and he's maybe took some classes. All of that is going to reduce his net profit.
Right. But he has to do a Schedule C, so he's got to do his own little tiny return, because if there's any profit, you worry about self-employment tax, even for him.
All right, then our nonprofit pays a flat fee of, I don't know what NG means, and issued a W-2 and insured with disability withhold several thousand. All right, now here's the thing: if you are exercising control, then and you're setting the fee and you're expecting them to perform a service in a certain way, then that's an employee. And it sounds like if that's what they're doing, that they have employees performing a function, then that's going to be W-2 and W-2 income. Most people are employees. The employer would prefer it to be self-employed because it'd be cheaper for the employer as opposed to having employees.
Right, non-for-profit. And I guess something also, and Esther, correct me if I'm wrong, a non-for-profit can never have a loss, and so her non-for-profit would, right? Yeah, you're giving me a
Well,
weird
because
look.
a not-for-profit doesn't pay taxes.
Yes, that's right.
But that has nothing to do with employees. You still can have employees when you
Yes.
have a not-for-profit.
Right. Yep.
So, again, when you're just reading a text, you really don't have much information, and we're not doing back and forth. So, again, I'd like you to maybe call me or go to my email at egtax@hotmail.com and give me some more information. But yeah, they sound like employees to me, and they're filling out a W-9, which
means we want
Right.
your social, so
Right.
we can issue you a W-2.
I'm Esther Golias, the tax lady
Or
from EG
1099.
Tax, 8030930, 8030930, star 930 on a cell phone, and our text line is 3930. We'd love to help you. Again, if you're getting letters from the state and they're asking you for proof, you got to submit the proof. If you haven't gotten your refund and you issued it to the federal government and it's been acknowledged and they're holding it up, they're probably doing a type of audit, and you just have to hold on to your knickers until they get the thing processed.
And then don't forget, if you want to do an extension, you can fill out the paperwork for federal and state, and you get an automatic 6 months to file, but it's not to pay. If you owe, you have to submit what you are supposed to owe, your liability, with those extension forms.
Right. So an automatic extension only automatically extends the time to send in that tax return. The money is due on April the 15th.
That sounds like an inconvenience.
Yeah, but that's what happens. And if you have a liability and you don't pay the liability with the extension, for all intents and purposes, the extension is null and void. So you're just spinning your wheels. You got to send 90% of the money that you owe with the extension in order for it to be valid.
Correct.
All right. The other thing is, when you have, and many of you that have gone through this year's tax situation know that a lot of the property taxes are being capped by the $10,000. So if you have that second home in North Carolina or in Florida, you find out that you aren't being able to get any benefit for that at all. So consider turning it into investment property, into a rental. That way, all the expenses will be deductible.
Yep, unless you're a married couple and you make over about $168,000, then they become suspended losses and they're not deductible.
Well, and that would be true unless you're a real estate professional.
Right, unless you're a
Right.
real estate professional.
Now, the thing is,
which not many people are.
well, but yesterday I did a tax return for a couple who make $300,000, and she has real estate licenses in 5 states, and so she is definitely a real
an
estate
exception.
person.
Yep,
Right,
that's an
true.
exception.
But the thing is, if you have that family home, that second home, a little tax tip would be to convert it to rental. If you can still use it 14 days personally and still have it retain its business characteristics, so you'd still be able to take the property taxes and the mortgage interest and the trip down there to do work in it, and insurance and repairs and supplies and dishes that you buy for the people. The advertising, it's all utilities are all going to be deductible, plus depreciation. And this way, you'll get a bigger bang for your buck.
I
and
know.
get some tax write-off.
That salt, that cap really has me
It's interesting.
shaken.
For those of you that have been stung by the salt cap, I just had a client in today who works in Washington, D.C., and I suggested that they do a class action lawsuit, and I think that she's going to think about doing it because they're treating business people in business that are doing that have expenses, they're deductible, but employees with employee business expenses, they're not letting them deduct it, and that's really treating two classes of citizens for the same deduction differently, and that's not. In this particular situation, this client is on a temporary assignment, and so they're getting income that would have normally been a deduction on a 2106, but they can't deduct it now, right? I'm Esther Gullius, the tax lady, 8030930, 8030930, star 9 at 30 on a cell phone, and we got Mike in Buffalo. Hi, Mike.
Hi. I was wondering if you could help me out with some questions on my Schedule C.
Sure.
I've been filing this for 15 years, and I had professional advice at the start of doing Schedule Cs.
You know that the law changes like every 10 minutes, but okay.
I mean, every 10 seconds in my
Yes, that's true.
story. So what's happened is through the years, I put down that my principal business is internet sales, which it still is, but my problem with it is this is the way it was coded originally, and I was told that what I could possibly do is when it comes to Part 2, when I look for the depreciation, I've been depreciating and keeping good track of that. But I was wondering if there was a simple way around this where I don't have to keep track of depreciation. And you know what bothers me, too, is the inventory. Because the day after Christmas, I go upstairs, I go to my storage facilities, and I just double-check everything, make sure all my inventory has got the right stickers on them. And that is the real nightmare for me at the end of the year.
Okay, that's two different things. So inventory and depreciation are two different things. Now, you said you've been doing this for 15 years. Your depreciation hasn't run out yet?
No, it hasn't, because I've also depreciated a property, so I have 28 and a half years.
27 and a half years on the property. Or is it business property, so it'd be 31 and a half?
I've had to buy computers, so I also depreciate them, I believe, on the 5-year deal.
All right, so you can do some, I don't know if you're aware of it, Mike, but you can make a 179 election on some of those 5 and 10-year assets and just expense them instead of depreciating them.
Yeah, I've thought about that, but it also depended on the year, I believe, because some years I think I was allowed 50%, and then...
Well, that's bonus depreciation. Right now, the bonus depreciation is 100%, and but the 179 is still in there up to, I think, $250,000. So I would suggest, if you don't want to mess around with the depreciation and it's machinery and equipment, if you got enough net profit and you don't think you need it next year, look at the 179 expensing, because that'll give you an opportunity to just write it right off.
But you asked if there's any other way, better, easier way to keep track of the depreciation. You have to do an asset worksheet, and that's something that you have to do every year.
Right.
There's no easier way, regrettably.
Yep.
Okay, so inventory is going to be a part of my life for the rest of the tax.
Well, and we're talking depreciation. Inventory is important because at the end of the year, let's say you had $1,000 in ending inventory and you bought $5,000 worth of new inventory. So that's $6,000 potentially for the cost of goods sold. And at the end of the year, if you didn't keep track of your inventory and you had $2,000 less, it would look like it was a $6,000 cost of goods sold instead of $4,000, which would lopside your Schedule C and would give you a big tax break that you're not entitled to.
Oh, we don't want to do that.
Right.
Definitely. Okay. You know what I think I'm going to do is I think I'm just going to write you an email at your firm, and I'm going to try to come in there this year and show you what I got, and then you tell me what the right way is.
You show us ours, we'll show us. You show us yours, we'll show you ours.
Yeah, and then
see if we can't help you.
And then don't forget about the QBI this year, because the
QBI is a
eligible.
great big thing.
Yeah,
that's the qualified business income deduction. What does your net profit usually run, Mike, a year? Around?
My profit's gone anywhere from like $8,000 to $23,000. For the last 2 years, it's been kind of slow. I'm 68, so I'm kind of slowing down a little bit, so to speak.
Well, if it's $10,000 this year, for instance, your QBI deduction would be $2,000. That's a lot of money to leave on the table.
Yes, it is.
Okay.
Okay, thank you very much.
All right, thanks, Mike. All right. I'm Esther Gullius, the tax lady from EG Tax, 8030930. 8030930, star 930 on a
Esther.
cell phone. Yes.
I just wanted to talk about, I sniffed out, if you will, 3 people that are brand new to me. They were referred to me, and one of them was doing her return herself. Mike made me think about it, and she was doing, her husband worked for the railroad, and she was doing her return by hand, and she wasn't using the simplified generalized method for 16 years. So I was able to amend 3 years, but her brother said, I told you to come here a long time ago. I felt sorry for her. And
Well,
then
let me explain what that means. When you're working for the federal government a long time ago, they were actually taking out after-tax dollars and to fund your portion of the pension. So when you're getting the money now, that means that you get to take out as from part of the taxable income, part of the money that you had already contributed because you've already paid taxes on it, and that's called the simplified general rule pension, and that's what Tiffany was saying. And so in this case, this guy was overpaying.
Yeah,
and they don't know to call and tell you overpaid.
All right. And another person who was referred to me, she was going to a CPA, and she has a government, a municipality, or federal pension, and they were only excluding $20,000 off of New York State. So I sniffed that out
rather than the
$35,000.
So let me interpret this again. So if you're retired on a federal, state, or a municipal pension, regardless of your age, all of your pension on New York State is tax-free.
That's pretty cool.
And any other pension, you'd have to be 59 and a half for annuity, and then the first $20,000 per taxpayer on husband and wife would be
I got
deductible
one
on
more.
the state. Yep.
I got one more who was referred to me, and she was going to a competitor that uses a light green logo, and she is disabled, and she has a pension, and she has Social Security and pension, and she's only 53, and they were missing the earned income credit for her.
Right.
And so I'm
going to interpret this again. If you're retired on a disability, and you're under normal retirement age, that would be 65, and you're getting a pension, and especially if you have children at home, or even if you have lower income, you would be entitled to, for tax purposes, move that income from a pension to wages and get earned income credit.
She was so happy.
Yeah, that's great.
Yeah.
All right, let's go back to this again, and we only have a couple minutes. If you are a C corporation, consider moving to an S corporation. It's a very simple form to do, because the flat rate on a C Corp this year is 21%, and many C Corps are much lower, would have been taxed last year at 10 or 15%. So if you stay a C Corp, you're going to be taxed at 21% versus 10% in many situations, so you're going to overpay. And the other thing is, of course, if you have a loss on your C Corp, you really need to move to an S Corp, because the S Corp would be deductible on your personal return, whereas the C Corp would not be.
Yikes.
Right?
Absolutely.
So during the week, if you're organizing your stuff and you don't know what to do, you can give EG Tax a call at our corporate headquarters at 632-7886. We have 30 area offices to serve you. Our website is egtax.com, and we're there to help you, and especially if you're getting letters or you aren't getting refunds or you're having any kind of trouble, we're there to help you. And the other thing is, we're coming to the end of tax season, and so many people are like sticking their heads in the sand, and they're thinking, oh my gosh, I don't really want to know what's going to happen. Now you want to find out, because if you do owe money, you want to figure out how you're going to be able to pay it. We'll help you with options. There's installment. You can do an installment obligation with the IRS. You know, you can
get a home equity
credit line to put it on there.
Your pension.
Right.
You can announce to the IRS that you're uncollectible, do an offer and compromise. I mean, there's options.
A lot of things that we can do for you. Until next week, I'm Esther Gullius with Tiffany Fabian. Have a great week. We'll talk to you if you need us. Bye-bye.